Good morning, everyone. I'm Curt, Carlyle's Chief Financial Officer. I'm excited to speak with you about how the priorities Q just laid out will impact our results over the next 4 years. I will cover many of our objectives for 2024, notably around distributable earnings, including fee-related earnings and net realized performance revenues, as well as fundraising. Then I'll walk you through how we plan to meet those targets and what that means for our shareholders. So let's begin. Over the last few years, we've focused on growing our fee-related earnings, and we remain very committed to that priority. Our funds have performed well, which not only benefits our fund investors, but has also driven our accrued carry balance to a record level. Given the craziness of this past year, I just want to remind everyone that last January, we converted from a publicly traded partnership to a full C corporation. So now everyone at Carlyle is fully aligned with our shareholders in a one share, one vote, one share class that is simple and transparent. We think this has made our stock more attractive and easier to own. Now, as you've already heard from Q, we formulated a strategic plan designed to accelerate our earnings growth, and we have aligned and incentivized our most senior executives with that plan by granting strategic equity awards that vest upon achieving the annual milestones in the plan. We believe this creates better alignment with driving shareholder value. The first 6 years we were public, we averaged less than $200 million per year in FRE, with margins in the high teens. Since then, we've been focused on growing our FRE, and FRE has steadily increased and more than doubled to $490 million in 2020 on an as-adjusted basis. At the same time, we've increased our FRE margins by more than 1,000 basis points to 30% last year. But let me be very clear. Our main focus is on absolute FRE growth. And as we scale and manage our expenses, margin growth should be a natural output. While it may be obvious, we can support higher dividends with higher FRE, but better margins with the same FRE will result in the same level of dividends. As we focused on growing our platform and FRE, our mix of earnings has also become much more balanced. Thinking back to when Carlyle was founded, the firm operated with a single purpose, mostly just to generate carry. When we went public nearly 9 years ago, not much had changed. And while investment performance will always be our top priority, we realized that growing FRE is equally important for our public shareholders. So even as we have had a cyclically slower amount of carry realizations over the past 3 years, we've been able to actually achieve reasonably consistent distributable earnings given this focus on improving our earnings mix. And we believe we can maintain a more balanced mix of earnings as we move forward. Even though our realizations may have slowed the last 3 years, our funds continue to deliver strong performance. One of the most important metrics that we track and that you should as well, our accrued carry balance, is at a record level and is over 70% higher than our average balance level from 2012 to 2017 when we were generating more than $600 million in annual realized net performance revenues. The accrual is a good indicator of future realized performance revenues. The recent decline in our realized performance revenue isn't because our funds weren't performing. In fact, it's almost the opposite. The decline over the past 2 or 3 years was mainly due to the transition of realizations between fund generations. Our older funds were just about fully realized, and our newer funds were just ramping up and not yet mature enough to take cash carry. Also, as you've heard from us consistently over the years, we don't like clawback, and our LPs don't like clawback either. We try to manage that risk by first returning a lot of capital to our LPs before we start to take cash carry. Now that our most recent generation of fully invested funds are more mature and have returned a lot of their capital back to LPs, we expect realized performance revenues to ramp over the next few years. So now, let's go back to what you heard from Q on our strategic plan. We're focused on accelerating our growth across 3 priorities. Let me explain how each are going to impact the results. First, accelerate and scale. We're going to drive higher management fees and operating leverage. Second, adjacencies. We're going to generate incremental revenue from newer streams. And third, institutionalize. We will control costs and align our senior executives with performance, and as a result, improve our margins. So first up, let's talk about earnings. Last year, we produced $762 million in distributable earnings, and we expect that we can more than double that over the next 4 years. Accordingly, DE per share of $2.05 in 2020 should increase to the mid $3 per share by 2024, accounting for an increase in our effective tax rate over that same time. As I said on the fourth quarter earnings call, you should expect effective DE taxes to increase from around 5% in 2020 to the low 20s in 2024, assuming no changes to the current tax laws. So again, we think we can grow pre-tax DE at about a 20% CAGR and per share earnings more in the mid-teens because of the increased effective tax rate. Our projected increase in earnings is supported by a few factors: a big step up in fee-related earnings and a threefold increase in realized net performance revenues. FRE was $490 million as adjusted, and by 2024, we believe FRE should reach $800 million with a margin that is up another 1,000 basis points or so from here, to about 40%. I mentioned on our earnings call that we see 2021 FRE remaining at similar levels to 2020. So you will see the vast majority of our expected FRE growth in the 3 years 2022 to 2024. In the near term, growth in global credit and investment solutions will offset downward fee pressure in global private equity from continued realizations. As we raise our next series of large flagship funds, global private equity FRE will also increase materially from its current levels. On our realized performance revenue, the bottom line is that our investment portfolio is in great shape, and many of our funds are ripe for much higher realized performance revenues. Now that you know where we are going, let me describe how we plan to get there. As Q said, our next multi-year fundraising target is $130 billion. Back in 2016, we set a 4-year fundraising target of $100 billion, up more than 20% from the $78 billion we raised in the prior 4-year period. And we exceeded our last multi-year fundraising target by 8%. So after a great 2020 fundraising year when we raised $27.5 billion without fundraising for any of our flagship global private equity funds, we're ready to set another multi-year target, $130 billion to raise between 2021 and 2024. As you look at where we've been, this target is big enough to matter and realistic to achieve. Nathan will provide a deeper dive into our fundraising plans, but at this stage, we're intensely focused on meeting the objective. As we reload our flagship funds over the next few years, we expect to see our fee revenues grow from $1.6 billion to over $2.1 billion. Most of this growth is tied directly to management fees, but some fee revenue growth will also come from greater transaction fees and capital markets revenue. Faster growth in global credit will rebalance our overall business mix, making global credit a bigger piece of an even bigger pie. Remember, our fee-earning AUM is very resilient. The vast majority of our capital is committed for the long term, and in many cases, a decade or more. As you'll see on the next slide, our fee-earning AUM has an attractive average fee rate and is a key contributor to our earnings growth. The fee rate on our fee-earning AUM has been stable at just about 95 basis points on every dollar. And in fact, that average rate should continue to be stable even as our business mix continues to change. Over the years, we've replaced lower-yielding fee-earning AUM with higher quality AUM. You've seen this in our investment solutions segment, as well as parts of our natural resources platform. And we will continue to prune unprofitable product lines because we care more about growing FRE than about growing fee-earning AUM, as not all AUM is the same, nor is it necessarily profitable. After growing fee revenues by scaling the business, we want to capture more fee revenues from natural adjacencies. In 2020, we generated $37 million in transaction fees, exclusive of portfolio advisory fees. We see that amount tripling by 2024. Our business generates a significant amount of deal volume and related underwriting and placement fees for investment banks, as Q discussed. Our plan makes capturing more of these high-margin revenues a priority, and we have already put the teams and structures in place and earmarked the capital to underwrite this business. Insurance is another area that should drive continued growth in our earnings, both from what we've already built, but also as what we continue to scale through acquisitions. From Fortitude, we see opportunities to increase and diversify earnings. Q mentioned we're generating about $50 million in management fees already, and we think that grows as Fortitude rotates more AUM to Carlyle Management. Fortitude is also operating exceptionally well, generating a mid-teen return on equity. Our $465 million investment in Fortitude is likely to generate higher investment income over the next several years. Or Fortitude may retain that capital and self-fund additional M&A. Fortitude can grow in multiple ways via new reinsurance contracts or M&A opportunities, and that we should both benefit from. We will certainly keep you apprised of our activities as we go forward. Let me now move to how we're going to run the firm better, something we refer to as institutionalization. We are pleased with the progress we've made over the last few years, but improvement opportunities remain. We've done a good job already growing FRE, as I mentioned before. The $27.5 billion in new capital we raised in 2020 creates great momentum as we head into 2021. But taking a step back, our primary focus in this regard is to ensure we're growing our top-line revenue in excess of our costs over a cycle. So in any one year, you may see that bounce around a bit, but we'd like to see a several hundred basis point difference over time between our top line and our expense growth. Obviously, that will lead to strong margin expansion. One of the ways we will achieve higher FRE margins is by scaling our funds while further leveraging our existing teams. Looking back over the past few years, we've already seen this play out, with our investment professionals managing more dollars of AUM on average than they have in the past. And as our next series of funds are raised, we should expect this trend to continue, meaning we expect to grow the asset size of our funds, and while we will add some people to better manage and deploy those assets, the growth rate of our revenues should far outpace that of additional expenses. Our goals are to raise larger funds and do bigger deals. And as we increase efficiency, we will drive FRE growth and better margins. Our deep knowledge base and expertise across our firm can help our deal teams collaborate to drive investment performance across more scale. As the day continues, I urge you to listen to each of our business leaders talk about scaling their respective businesses using a platform approach. We've also been methodical over the past few years pruning funds that can't scale, such as our funds in MENA, Mexico, or Africa. This process has the benefit of helping our FRE and margins as those subscale funds did not drive earnings, and also helps us focus on our most scalable strategies. Our plan contemplates continued pruning and rebalancing as we go forward. It's not just compensation and headcount that we're focused on. It's our entire expense base. We learned a lot over the past year as our entire firm moved to a work-from-home environment. Some expenses like travel and conferences are likely to come back a bit as we start traveling more. But some of what we've learned about virtual meetings and working differently will absolutely carry over into lower expenses versus pre-pandemic levels. 2020 G&A of $271 million, which excludes $30 million of one-time cost recoveries, was down 22% from 2019. As I said on our earnings call a few weeks ago, G&A expense is likely to increase in 2021 due to a normalization in travel. But we believe G&A expenses should remain below prior peak levels as we work differently and more efficiently than we have in the past. All of this should be doable. Now let's spend time discussing how our strong investment performance should lead to increased realized performance revenues. First, our accrued carry balance of $2.3 billion positions us for higher realized carry over the next few years. And when you look back over time, we typically realize performance revenue in any 1 year at about 40% of our accrual balance. Now that's a correlation and not a causal relationship, but historically it was a fairly reliable guide when we were exiting at a good clip and our funds were taking carry. That percentage dipped in the past few years. As I mentioned earlier, the main reason for the decrease was due to the transition between fund generations, and the newer funds weren't yet taking cash carry. But with our newer funds performing well and assuming generally benign macroeconomic environment, after performance revenue gradually increases in 2021 over 2020, we should expect to see a recovery back to a more standard pull-through of our accrual balance, helping us surpass our prior annual net realized performance revenue averages and reaching about $800 million by 2024. Digging into our accrual a bit more, we see 3 buckets of what makes up our accrual. First, from those funds already taking carry. as these funds are not only performing well, but seasoned enough and having returned enough capital to fund investors for us to feel comfortable taking cash carry. Our biggest contributor here is our most recent fully invested U.S. buyout fund, which has accrued $1.1 billion in net performance revenues. This fund is already marked at 2 times cost, with strong performance and value creation still in front of it. The second bucket is for those funds not yet taking cash carry, but are performing well, just not yet meeting all of the criteria to take cash carry. A good example is our most recent fully invested Asia buyout fund, which we think is moving in the right direction to take cash carry sooner rather than later. The third bucket is for newer funds that may come in and out of carry early in their fund lives, but are still a ways away from taking cash carry. We'll keep our eyes on these funds, but probably a year or more away from carry realizations. A final bucket that isn't shown is the group of funds across our platform that are investing right now, that are not currently in accrued carry, but we expect to drive our accrued carry balance in the future. A prime example is our most recent $18.5 billion U.S. buyout fund, Carlyle Partners 7. At $5.5 billion larger than Carlyle Partners 6, we're excited about its potential. The main message is that we have a strong pipeline of performance revenues to come, and that should gradually increase this year compared to 2020 and start to significantly ramp thereafter. One last way to look at our forward trajectory of our performance fees and realization cycle is just how much money we have in the ground appreciating. Today, we have about $95 billion in remaining fair value in our global private equity and global credit carry funds. To put that in perspective, that's about 50% higher than the average levels we had in our last cycle of high realized performance revenues. This should not be surprising, as our most recent generation of carry funds are 30 to 40% larger than their predecessors. And as our newer funds also continue to scale, we expect remaining fair value to trend in a similar direction. So when you consider that our funds are 30 to 40% larger, our accrued carry is 70% higher than it was several years ago, and our assets in the ground are also 50% larger, we see strong underpinnings for realized performance revenue to ramp from here and beyond the levels we've produced in the past. Let's move to realized investment income generated from our balance sheet. Over the last 4 years, our balance sheet investments have more than tripled to $1.7 billion. That includes investments into our funds largely, but also our investment in Fortitude. Our balance sheet investments will continue to grow alongside our fundraising goal of $130 billion. In 2020, our realized investment income was $73 million, which is up compared to prior years, but we think it is at the beginning of a strong growth cycle. In fact, we expect that our investment income can get to about $150 million per year, though that'll vary somewhat by what is sold each year. Clearly, we have a lot to look forward to, but the future isn't without some challenges. You'll hear a bit more about this from Pete in a few minutes, but let me frame our carbon energy footprint for you. But more importantly, why we are very excited about the opportunity for us to transition along with the industry towards a greater focus on renewable energy. Without a doubt, we have a big carbon energy business. Our energy funds have provided attractive investment opportunities for LPs in the past, and we believe they will continue to do so in the future. But the market is shifting, and LP focus is shifting with it. As the demand for renewable energy investments increases, investor interest in carbon assets has decreased. We've already seen this transition occurring, as our carbon-based energy AUM has decreased over the past few years from 12% to just 8% today. Over that same time, we've launched new funds in infrastructure and renewable energy to capitalize on the energy transition, and our teams are actively investing in those funds. One thing to keep in mind, in our strategic plan and the guidance we've provided today, we project our carbon energy AUM to decrease and become a smaller contributor to management fees. That said, we will continue to earn management fees for a long time off this platform. But we do have the potential to benefit from a lack of new capital into the sector, which could lead to energy production shortfalls and potential profit windfalls. The real takeaway is that we are focused on transitioning our natural resources exposure towards renewable energy through our integrated infrastructure platform. Now, let me finish by pulling all of this together, starting with how we think about our balance sheet capital and what that means for our shareholders. As we execute our strategic plan and generate higher earnings, there are several areas we want to focus on to allocate our capital. First and foremost, we are focused on maintaining and growing our quarterly dividend. After-tax FRE is the guide point and support for our dividend. And as we've discussed, we are optimistic on the trajectory of our FRE growth over the next few years, and then on a lag basis, seeing our dividend grow. Direct investments in our funds are also an important use of our capital, as it helps align our interests with fund investors and supports our earnings growth as well. We'll also need capital to organically grow new strategies and support our growing capital markets business, which will require more funding capacity from the firm. We constantly evaluate strategic M&A opportunities, which is hard to predict, but ultimately will require capital that we have on our balance sheet today or capital that we'll need to raise. Keep in mind, any completed strategic acquisition will have a positive incremental impact on top of what we've discussed here today. And over time, plan to limit annual equity dilution to about 1%. These items are not in order of priority, but all are critical to a sound capital allocation strategy. Our priority for excess capital is to accelerate platform and earnings growth. Now let me just again highlight what this means on a per-share basis for our shareholders. As we accomplish all that we are projecting, we expect to see our earnings growth per share grow at a mid-teen CAGR over the next 3 to 4 years, reaching the mid-$3 range by 2024. That's attractive growth and something we're excited about and hope you are as well. So before I conclude, let me remind you of what you're going to hear over the next few hours. You should specifically listen to the subsequent presentations for the following: how our respective businesses plan to grow, how we will take a platform approach to scaling each business and improving earnings, and how we create value for our investors. In addition, you will hear how we harness data and use it for better decision-making, as well as how we are increasingly embedding ESG into all that we do. So in closing, thank you for your time today, and I look forward to keeping you updated on our progress over the next few years.